Hi everyone, it's Jack about another video. Today I'm going to be talking about two dividend stocks which I think will be significantly better investments over the medium to long term than AT&T, which is a popular dividend stock which I often see talked about and high up in lists and things like that. And it's mainly popular because the stock has been down significantly, so it's seen as a value play and it pays around 7% dividend yield, which looks very tempting, and I have been tempted in the past, but the more you read about it, the more dangerous it looks. It's destroyed shareholders over the medium term. It's down 35% over the last 5 years. Pretty much any time of buying it has been a poor time to buy it. It's recently reduced its dividend in the start of 2022, halved its dividend yield, which is obviously not good for investors, so they were pretty burnt there, and it took a significant hit to the stock price. And I think it probably, for the good of the business, needs to cut its dividend again. It's, relatively speaking, a free cash flow machine, but terrible acquisitions. It's even had to spin off many of those acquisitions recently have caused this business's balance sheet to be one of the worst you will see, likely. Total debt of 155, nearly 156 billion dollars, significantly more than the market cap, and actually increased over the 3 months from the end of last year to the first quarter. Net debt of 134 billion, that's also increasing. This just looks like a dangerous company to me. Shares are not really going anywhere. I don't think this is a particularly good investment. I think the dividend is going to be under significant pressure. There are two companies that I think are significantly better. The first business I want to talk about is Home Depot. While the dividend yield is absolutely nowhere near that of AT&T, it has thoroughly crushed AT&T over the long term. Now this graph's a bit unfair because Home Depot is a multi-bagger over the long term. But even in the last 10 years, it's been an absolutely tremendous performer just in terms of stock appreciation. The dividend has ballooned and it's 25% off its all-time highs it achieved in December 21. It's decently off its 52-week highs, currently trading around 19 times trailing earnings. Not overly expensive. Let's look a bit deeper. The climate for Home Depot has gotten a little tougher, and it's probably the toughest it's been for about 10 years for this business. Higher interest rate environment typically pushes trends like home improvement downwards, makes it a tougher environment for these businesses. However, the business still performed annually in 2022. Comps up 3.1% from 2021, which was a particularly strong year. Diluted earnings per share of $16.69, $6 billion of sales growth, and $157 billion in sales. This is a business that has just continually compounded over the medium term. It is, by pretty much every metric, a fantastic place to work, fantastic business. It's extremely admired. And it also has an extremely strong market position. Its total addressable market is almost $1 trillion, and that is really an estimation here. Its pro market is predicted to be around $450 billion, with the consumer market being about the same, and it's predicted to have around a 17% market share. Now that may not seem like a lot, but this is a very fragmented market outside of Home Depot and Lowe's, which kind of exist in a duopoly, with Home Depot having fractionally more. Many of these others are smaller businesses, mum and pop style places. Home Depot is the dominant player in this industry, in my opinion, and in many people's opinion, and its market share is only predicted to grow, and it has the name brand recognition. It has tons of economies of scale. I think this business is going to increase not only its market share, but increase with the market, and it's not going to achieve the entire total addressable market by any means, but there is market share to be had for sure, and I think its economies of scale are only going to help, and particularly as the economy brightens up, which it eventually will, disposable income becomes more available. I think Home Depot could be really strong in the next few years. While again I mentioned trailing dividend yield around 2.6%, nowhere near AT&T's, but when you factor in the long-term appreciation, long-term compounding of this business's stock price, and the dividend growth per share, which is absolutely staggering, $3.56 a share in 2017, $8.36 now. They're buying back a ton of shares. When you combine the buyback yield and the trailing dividend yield, we're looking at around a 5% total yield. Shares outstanding in the last 15 years have gone down from around 1.7 billion to around about $1 billion, which is an absolutely staggering decrease in shares over that time. These are all trends that are dramatically improving shareholder returns. Quite the opposite of a company like AT&T, which in my opinion has burnt shareholders on several occasions. Obviously businesses like this are no secret to investors, and it's not overly cheap by any means, but I think this is exactly the type of business that is dollar cost averaged over a long period of time. I think at current prices, it's about average where it normally is over a 5-year period. It normally trades at a decent premium to the S&P 500. It's currently trading about in line with the S&P 500, albeit the S&P is looking quite inflated due to the dominance of the big 7 or so tech companies. Price to earnings on a trailing basis of around 19, forward basis around 20, and a price of cash flow of around 19 are about average and about what I would be willing to pay for this business. We're looking at an earnings yield of around 5% currently. That's slightly better than 5-year averages. I like Home Depot at this price, and I'm going to be dollar cost averaging for a significant amount of time. Second business is United Healthcare, which has again been an absolutely staggering performer since it's been on the public markets, currently trading for a price to earnings on a trailing basis of around 22, and again has an even smaller dividend yield, this time at just 1.56%. And this is something that important that I would like to say about my strategy is chasing dividend yield is a mistake in my opinion. Chasing long-term dividend growth companies that grow their dividends at outsized rates is where I would like to park my money in safe, stable, high free cash flow producing businesses, and United Healthcare is definitely one of them, one of the leading providers of healthcare in the world, or healthcare insurance in the world. The business has compounded revenue over the last 10 years from around 120 billion to now over $300 billion. Absolutely staggering economies of scale. It's still producing quality returns in generally in around the 10% revenue growth range. They see their long-term outlook for earnings per share growth around 13 to 16% on average. It is very difficult to have a bad investment. You're paying a reasonable price for a company that is returning earnings per share growth in this sort of range over the very, very long term, in my opinion. The business has authorised double-digit increases in the dividend every year since 2010. And again, while the trailing dividend yield is not very large, that is because the stock price has seen a significant amount of appreciation. The dividend is still growing rapidly, $2.88 per share in 2017, now currently $6.83, so again more than doubled. Buybacks are not a huge amount here, but this is a very large market cap business, as with Home Depot. Total yield around 2.64%, generally outsized stock price returns, and over time, while not buying back as many shares as Home Depot, it's still bought back and brought down its share count a significant amount over the last 14 or so years, from around 1.15, 1.16 billion to now under a billion, almost down to the 900 million range. This is a long-term trend. They keep it a very, very conservative payout ratio of around 30%. This is a generally reliable company. It's not a dividend aristocrat. It's only paid out dividends for the last 14 or 15 years. But this, to me, looks like a generally reliable business that has long-term tailwinds behind it. I don't really see any warts on the horizon. I can't see a major healthcare reform in the US coming anytime soon, in which case United Healthcare is probably going to be a significant outperformer continuing into the future, in my opinion. Again, just like Home Depot, businesses like this, that are high quality businesses that have compound over the long term, do not come cheap. Price to earnings on a trailing basis around 22, forward basis around 19, right in line with its 5-year averages, slightly higher than the S&P 500 on a trailing basis. Price to cash flow of around 12, which is significantly lower than its 5-year averages and lower than the S&P 500 averages. PEG ratio of 1.54 is nice, right in line with the 5-year averages. This is a very fast growing company and continues to be a fast growing company at this size and scale. 10% growth in this industry and this size and scale is absolutely fantastic in my opinion. 4.55% earnings yield is very respectable for any business, even if it is about in line with the 5-year averages. For me, this is a buy here. I'm going to continue adding, and I can't see any reason why AT&T would be a more attractive investment than these two. The fact that it is very easy to plot price to cash flows and do valuations of businesses like this compared to AT&T, because they are consistent producers that are putting shareholders first, which I cannot say for AT&T stock. It just looks a mess to me, and chasing dividend yields is really the best source of outsized returns over the long term. But of course, that's just my opinion. You let me know your opinion in the comments down below. Let me know what you think of AT&T, what you think of the other two businesses I mentioned, and give me some other suggestions of long-term compounders that have grew the dividend significantly and that have grew the stock price significantly over the long term, or what you think will be those of the future. Let me know in the comments down below. Of course, all this is just my opinion. I'm not a financial advisor. You should do your own research and due diligence. Capital is always at risk with these sort of investments, and you should speak to a registered financial advisor, because of course this is not financial advice. Let me know anything in the comments down below. See you next time.